Hey everyone, let's talk about investments, specifically about fixed income. Now we're going to start with fixed income in terms of our more quantitative analysis, precisely because it's mathematically more challenging, ironically, due to the fact that there's more known in fixed income valuation than in equity valuation. So when we get to equity valuation, we'll talk about complicated proxies for expected returns like factor exposures. But with fixed income, you don't have to worry about that because there is rather little uncertainty. You know what the payouts to a fixed income contract will be. You may not know what the interest rate will be at the time. But because it's more well defined, the mathematics is actually ironically more challenging just because you can actually do more with it, and instead of calculating expected returns, you can pretty much calculate what the return on a fixed income investment will be, given a certain interest rate. So fixed income analysis is a good place to begin because conceptually it's relatively simple, even though mathematically it's quite difficult. By the time we get to equities, you'll see that the relation will in fact be reversed. Equities are conceptually more difficult, but mathematically the analysis will be much simpler than what we do here. So this part of the discussion will be based on Bodie, Kane, and Marcus, chapters 14 through 16. And we're going to start with a discussion about bond overview, bond pricing, and performance measures. We're going to talk about forward rates for interest. We're going to talk about the term structure of interest rates. And finally, how to manage the risk that you face from changing interest rates in a fixed income portfolio. So we'll go all the way to portfolio management with fixed income. So let's begin with a discussion of bonds and specifically their performance measures. So in our initial discussion about sort of the landscape of financial assets, we talked about some of these definitions already. We know that a bond is a debt instrument. It requires the borrower to pay to the lender a certain amount of fixed income, which is why bond analysis is called fixed income analysis. The interest payments are predefined, both in terms of how much they are and when they happen. And another good reason to begin here is simply because of the scale of the market. The equity market gets a lot of coverage, but actually in terms of raw size, the bond market is bigger than the equity market, so it's in some ways more economically significant. So what are the main features of bonds? We know that as a financial asset, a bond is a claim on a real asset. We know it's effectively a borrowing arrangement with a certain interest rate and a certain repayment schedule. But let's get into the details a bit more. So who issues bonds? Well, we talked about in our prior discussion about how some of them are issued by the US government, some by municipalities, states and government agencies, but also by private companies and by other countries, by foreign governments, those we call sovereign bonds. As far as the details of the bond contract, well, obviously an important one is how long the borrower has to actually use the money for and by when they must repay it. So we call that the term of the bond, and that's literally just the number of years to maturity. As we talked about in the sort of definitional landscape of financial assets lecture, we call short maturity debt anything less than a year, and anything more than a year we call a long maturity debt contract. An example of short maturity debt would be a treasury bill or a certificate of deposit or commercial paper. And for long maturities, we can have things like treasury bonds, corporate bonds, and indeed a special type of bond called a consol, which is a perpetual bond. These are relatively rare, but you can think of these as similar to the preferred stock example from our financial asset lecture. Essentially, this is just a financial asset that pays a continuous stream of interest payments, but never comes due. You never actually get your principal back. You just keep receiving a certain coupon payment forever. Now, the price of a bond is usually quoted in terms of a percentage of par value, or what we otherwise call face value, how much has been borrowed. And the reason we do that is we want to express the price of a bond as a percentage rather than as a dollar number, simply because the scale of borrowing can vary. But if we express it this way, then we can actually compare bonds to each other more easily than if we had one bond that cost $100 and another bond that cost $1,000, simply because different amounts were borrowed. If everything is on percentage terms, everything is comparable. And relating the price of the bond to the par or face value, there's three types of jargon that people will use. They'll call a bond a par bond if its price is equal to its par or face value. They'll call a bond a discount bond if its price is below its par value. And they'll call a bond a premium bond if its price is above its face value. Now you may wonder why the price might be below or equal to or above. I guess below is maybe the most natural one, because you're only going to get the face value of the bond back at maturity. So, $1 today is worth more than $1 tomorrow. That means that bonds should be worth less now than what their face value is, because you'll get that face value only later, right? So how could you have a par bond where somebody thinks that actually the fair value of this bond is its face value now, even though you only get the face value later? Well, the obvious answer is coupons. If the coupon is high enough, you will get some interest payments up front, and if they are high enough, then mathematically it'll work out that the present value of the coupons plus that face value when it does get repaid is actually equal to the nominal amount of the face value right now. And in fact, if we extend this line of thinking, then we can imagine a bond with coupons higher still, whose present value right now is actually higher than the face value of the bond. And that is how a premium bond would come about. Essentially, a discount bond has the lowest coupon, or maybe no coupon. A par bond has a middling coupon, and a premium bond has a really high coupon. So, speaking of coupons, the overall coupon rate is going to be the sum total of the interest payments paid out by a bond over the whole year as a fraction of face value. So, for example, a bond that pays, let's say, an $80 total coupon payment over a year, and has a face value of 1,000, well, that would have a coupon rate of 8%. And this could actually happen in a number of ways. It could pay you one payment of 80 all at once. It could pay you two payments of 40. It could pay you four payments of 20, and so on. And the number of times that the bond makes payouts is called the period. In the US, commonly these bonds are semi-annual, so they make two payments per year. In Europe, often bonds are annual, but again, they can be quarterly, even more frequent if there's a market for it. Now the coupon rate can be fixed, such as an 8%, or it can be variable. Remember, fixed income doesn't necessarily mean that the payout is fixed. It can mean that the rules governing the payout are fixed. In other words, there's some formula. So if you imagine, or if you define what floaters and inverse floaters are, well, those are bonds that have the coupon rate tied to the interest rate in some deterministic way. So floater will be a bond whose coupon rate rises with the interest rate, and an inverse floater will be a bond whose coupon rate falls as the interest rate rises. You can imagine that a bond whose coupon rate rises as the interest rate rises is actually a safer security, just by sort of time value of money reasoning, because a bond gets discounted, right? And as the interest rate rises, the bond gets discounted at a higher rate, it's worth less. Well, if the coupon rate also rises, as it does in a floater, that'll offset this drop in bond valuation, therefore smoothing out variation in the bond's price introduced by changes in the discount rate, which is the interest rate. Now, furthermore, the coupon rate can be nominal. In other words, you get what you get, or it can be more like a real rate, where, remember, the difference between nominal and real rates is the rate of inflation. So you can have Treasury indexed, inflation index securities, Ts, or inflation protected securities, TIPS. Those are bonds whose coupon rate is indexed or rises with the rate of inflation. And again, just as with changes in the bond's value due to fluctuation in interest rates, a bond whose coupon rate changes with the rate of inflation effectively protects the investor from price fluctuation induced by changes in the rate of inflation. And finally, of course, there's bonds that actually pay no coupon at all, a zero coupon bond. These are relatively common for short maturity treasuries. You'll simply buy the treasury bill for a certain amount. It'll be less than the face value. It won't pay you anything until maturity, at which point you will receive the face value. And the sort of incentive you get to do it will be the fact that you receive more than you paid in. And therefore the rate of return is just determined by this price difference. Now, the other thing is, of course, what currency the bond is denominated in. We talked about in the financial assets lecture about Yankee bonds and samurai bonds, the idea that you could have a company that is domiciled, let's say in Europe, but they want to market their securities, their bonds, to either investors in Japan or in the US. So let's say a German company will issue a bond denominated in yen and traded in Japan. Well, that'll be called a samurai bond. And if they issue a dollar-denominated bond that trades in the US, that'll be a Yankee bond. And of course, this will be a bond that trades outside of the company's domestic market, in this case, Germany. And another type of related bond, a euro bond, is a dollar-denominated bond that trades outside of the US. Doesn't necessarily have to trade in Europe, just anywhere outside of the US. And that is a bond that is, of course, then not regulated by the Federal Reserve. It isn't under the jurisdiction of the SEC, but it also just allows US companies access to markets outside of the US in terms of raising capital. Now, bonds, or well, any type of investment, faces certain probability that it won't actually be repaid. And generally, the bonds issued by the US government, the federal government, are considered about as risk-free as you can get. There are bonds that are issued by the governments of some countries that actually have been defaulted on. For example, Argentina. There are bonds that are issued by private companies that, of course, are even more frequently defaulted on than bonds issued by governments. So you can think of credit risk as sort of a spectrum. On the one end, you will have bonds issued by really sort of solid governments that have not defaulted in the past and don't look like they'll default in the future. Then a little bit lower on that scale, you may have governments that could default or have defaulted in the past. And lower still, you have companies that may default, and lower yet, companies that are actually in serious risk of defaulting. That would be something like a junk bond. Now, another important dimension of bonds is seniority and the security that underlies the bond. So bond seniority, just as we know that bonds supersede preferred stock and preferred stock supersedes common stock from our financial assets lecture in terms of priority of repayments, within the bond class, there is yet another ranking of priority. So senior bonds will actually be the first to get repaid. Subordinated senior bonds will be the next. Junior bonds will be next. Assuming that there's no other bonds and there's something left over, that remaining money would then go to the preferred shareholder. And once that is paid off, then the remainder will be the residual claim that is owned by the common equity holder. And related to seniority is also securitization. Or sorry, not securitization, but securing of a loan by a certain underlying collateral. Now this can be property, it can be equipment, some other assets, or even a stream of income, something that the creditor, the investor who's actually put their money into the bond, could actually take hold of should the bond be defaulted. Now, related to this, maybe indirectly, but you'll see how this impacts the credit risk of a bond and sort of the general safety that an investor might have in making the investment in a bond. A sinking fund provision essentially obligates the borrower to buy back a certain amount of the bond each time, each year. You know, it could, for example, be 10% per year. And what this means is that over the life of a bond, let's say this is a 10-year maturity bond, 10% of it is going to get bought back each year. Now what this means is that whoever happens to own that particular portion of the bond issue that was bought back in a given year is then, of course, safe from any further default risk because they've already received their money back. So in other words, a sinking fund provision in a bond returns capital to investors sooner and therefore reduces their possibility of loss just because they get paid back sooner. Now, another characteristic that's important in understanding the riskiness of a bond is covenants. Since the bond contract is very much a contract can have provisions in it other than just repayment terms. And this is what covenants are. They can do things like restrict additional issues of securities, or restrict dividends, or prevent the borrower from taking some other corporate actions, essentially all in the name of safeguarding the interests of the investor. So for example, they could say you can't pay a dividend unless you hold a certain amount of cash relative to total assets, or you have an interest coverage ratio of a certain level, essentially trying to preserve cash within the firm that would first go to satisfy the claim of the bondholder before it can be used by management for other things like paying dividends or making acquisitions or paying, salary, issuing options, what have you. And an important dimension of bonds that might actually affect both the investor and the borrower is option provisions. Now, we talked about some of these in the financial assets lecture, but to review, callability is actually an option that the bond issuer, the borrower, has. And what it lets them do is buy back the bond at a certain time before it matures. Why might they want to do this? Well, primarily if interest rates fall, they might find it advantageous to refinance, pay back the money that they borrowed at a high interest rate, and then re-borrow at the current lower interest rate. This is, of course, advantageous to the borrower, less so to the investor, because they're going to find themselves getting their money back, specifically in an environment where interest rates are low, so they'll have reinvestment risk. But what this may mean is that they can then perhaps ask for a higher coupon rate to compensate for it. Now, related to this, and in a way sort of the opposite of it, putability gives the investor, the lender, the right to demand payment on the loan before maturity. Now, if callability gives the borrower the right to pay off the loan early, why would the lender potentially want the right to make the borrower pay the loan off early? Well, most often it's going to be because they're worried that the loan will get paid back at all. So if it looks like the company that has issued a bond with a putability provision runs into some difficulties, then the creditor, the investor that actually bought this bond, can exercise the putability option and demand their principal back right now, which, if they do promptly enough, may actually save them from losing the principal if the company actually is about to go bankrupt, because then they jump to the head of the queue ahead of anybody else making a claim. They get their money back first, and only then does the company potentially later enter bankruptcy proceedings. And we talked about convertibility. Now, this is the idea that you can, as the investor, the lender, actually take your bond and convert it. You have the right to do this, to convert it into stock. Now, why might you want to do this? Well, because the stock, of course, has upside. A bond being sort of a fixed income investment instrument doesn't really have any growth opportunities, whereas a stock does. So if you find yourself as the bondholder of a company that has really good growth prospects, and you happen to hold a bond that has a convertibility provision, well, then you might actually choose to give up your bond, convert it into a certain number of shares of stock. Now, this will be predefined in the bond contract, and then you get to participate in the upside. Now, both the putability and convertibility are options that benefit the lender, the investor that buys the bond, and so perhaps then this investor would be willing to take a lower coupon payment in exchange for these optionality protections or benefits. So this is sort of why these provisions exist. There's something else to throw into the package that benefits either the borrower or the investor, and may then let them negotiate the interest rate that the bond pays in a bit more depth. Now, credit risk is, of course, the idea that maybe you won't get paid back at all. And this, of course, impacts the value of the bond, because as an investor, the higher the credit risk, the more you will want in compensation for bearing it. So usually this translates into simply a higher coupon. If you look at coupons paid by investment-grade bonds versus junk bonds, sometimes junk bonds will pay super high coupons, above 10% per year. But that's precisely because there's some chance that they will stop paying them and will not even pay back the principal, because the company that borrowed this money under a junk bond issue is now actually bankrupt. So because credit risk actually impacts the value of the bond directly in terms of affecting its cash flows, that's something that is compensated for then by a higher coupon. And it doesn't necessarily have to be just default. It can be simply downgrades or sort of a credit spread relative to a more safe security. There's different ways to measure credit risk. But the higher the credit risk, the more worried the investor, and therefore the higher the coupon. Now, default risk specifically is the idea that the issuer may not pay the interest or principal when it is due. And more generally, it can in fact be a violation not of the contract provisions defining payment, but let's say a violation of one of those covenant terms. Maybe the company does want to pay a dividend when the covenant prohibits it, or it wants to acquire another firm when the covenant says that they can't. All of those would actually be default cases. And in that case, well, what happens after default? Well, if it's a payment issue, then really the only two choices are renegotiate the contract or file for bankruptcy. If it's a covenant issue, then maybe usually the bond contract will say that if you violate a covenant, the bond is immediately due. Well, maybe the company can just pay the bond back. If they can't pay the bond back, then we're also back to this situation where you either have to renegotiate or file for bankruptcy. Now, bankruptcy comes in two flavors. Liquidation, which means that the company is no longer a going concern. It can't be saved, so all really that remains to be done is just to sell off the assets, recoup as much cash as you can, and pay back what creditors you can. Maybe something left over for the equity holder, maybe not. Whereas reorganization is sort of the more lenient type of bankruptcy that suggests that the company actually can be saved. It's still potentially a valid going concern. It just needs to be reorganized. Maybe there needs to be some change in the company's operations or its management, but eventually it'll get back on track. It'll come out of reorganization and get back to paying off its debts. So how do these issues of credit risk and default risk get reflected in bond ratings? Well, there's three big rating agencies in the US market, Moody's, S&P, and Fitch. And for example, S&P and Moody's have essentially sort of like a code for different rankings of creditworthiness. So they will have, for example, the highest, most creditworthy, least likely to default bond in the Standard & Poor's system will be a AAA. And Moody's will be a AAA as well. Really, these are homologous until about the time you get to the low-quality junk bonds, where you can see that a CCC under Standard & Poor's scheme is called a CAA under Moody's scheme. And then if you get all the way down to the very junkiest of junk bonds, the lowest credit rating that S&P issues is a D. The lowest credit rating that Moody's issues is a C. But generally, the lower you fall in the hierarchy, the more likely you are to default. And of course, this is simply one way to measure credit risk. Perhaps a better way, if available, is to look at the spread in a credit default swap. And there's also some empirical measures of a company's creditworthiness, such as the Z-score. But this is a useful sort of benchmark for comparing companies one to another in terms of their credit rating.